Everybody, my name is John Brice. I'm fund manager at NFU Mutual and sit on the Midlands board of the Investment Property Forum, and I'm delighted to welcome you to this afternoon's session, exploring a new way to invest in real estate and the hunt for yield. I don't know about you, but certainly my experience at the moment is certainly very focused on the future, even in the short term, looking at business plans, strategy for the year ahead, but also hoping for perhaps a better second half of the year with vaccinations ramping up and the prospect and spectre of COVID starting to diminish. But that being the case, I'm delighted to introduce this afternoon's session where we're going to explore some of the future themes that I believe are going to be vital for us in terms of investment in property, and try and answer some of the thoughts and themes around how securitisation and fractionalisation might present some new opportunities for investors over the course of 2021. We've got three great speakers this afternoon: Bould, Adrian, Benedict and Stephen Barter. I'm just going to introduce them and give you some information and some of their bios, because they truly are very impressive speakers, as I'm sure you'll be aware, and have some real heavyweight knowledge around the industry. So turning to Rob Bould first, he's a non-executive director at IPSX, formerly chief executive officer of Billfinger GBA, and has had previous roles as chairman and life member of the Investment Property Forum nationally. He's a past master surveyor of the Surveyors Livery Company, and also owns his own consultancy business with various senior advisory and non-executive director roles, including at Fiera Capital and the IPSX Group. Adrian Benedict is head of real estate solutions at Fidelity International. He's responsible for capital markets, fund structuring and developing bespoke client solutions. He's also leading Fidelity's transformative initiatives around the single data platform and frictionless investment in illiquid assets. And then lastly, and by no means least, Stephen Barter is chairman of Wilton Capital Advisors. Stephen has over 40 years experience in the real estate industry and held a number of senior leadership roles, including with sovereign wealth funds, an international property company, private equity investment bank, and international real estate consultant, being Richard Ellis, or now CBRE. In terms of this afternoon's session and a bit of housekeeping, I believe you are naturally muted by virtue of the software that we are adopting, but if I could just ask you to double check so that we avoid any background noises that were unintentional. And in terms of questions and answers, you will note on your software that there is a Q&A box. If I could ask you to put any questions in that box, we will then have a session answering that once the team have spoken, and try and answer some of your questions. But I suppose that's probably it from me. So over to Rob to start us off, please.
John, thank you very much indeed, and good afternoon, everybody. Great pleasure to be invited by the Investment Property Forum West Midlands branch to address this topic. And in my presentation, I just want to pick up three key themes in the 10 minutes that I've got. The first is the securitization journey and some basic fundamentals as to where the market is today. The second is IPSX, what it is and what it isn't. And the third element is public sector funding and the requirements that that is going to have. Let me just kick off. I joined and was a founding member of the IPF in 1988. And I remember sitting in High Holborn at the Prudential, and Michael Mallinson was the first president. And Michael stood up at the front of the room and talked about real estate, I think he called it property in those days, as being a mainstream asset class. And boy, he had no idea the length of time it was going to take before we really started knocking on the door. But that time is now, in my opinion. Some fundamental points in the world today. Nobody can have missed the fact that at December, we had £2 trillion worth of debt in the economy. nobody, bearing in mind if they've been on IPF courses, can have failed to know that there is a correlation between property returns and GDP. To remind you, it's about 60% correlation, and that actually relates to a negative, I think is the consensus view, of 11% GDP last year, and some very low forecasts going forward. But the IPF consensus forecast will no doubt tell us about that. So economy, well over leveraged. We'll go through 100% fairly shortly. Big issue. Second big issue in the fundamentals is the round trip costs of holding real estate, direct real estate. Even before you start presenting your performance figures to your investors, you've got now 8% plus round trip costs. In the economy that faces us today, the current structuring that we have got with those costs do not bode well for ensuring we're a mainstream asset class. Again, we've now got Brexit, and yesterday I received, as others did, a paper from John Gunn about the UK funds regime, which is under a consultation and review at the moment. The funds sector of the market is undergoing a complete review to ensure that we remain as competitive as we should be as a marketplace in London and the UK. But the big point in fundamentals I want to talk about is the structuring of how investments are held. I talked about round trip costs, but the reality is that the idea that one had a limited life fund and you sold it at the end of the day is going to give way to a perpetual structure. Doesn't mean any of the services on the people on this call are going to be any less. It just means they're going to be different, and the asset managers that are going to be provided, and perpetual funds with a market to actually trade units on a daily basis will play to the big dynamics in the marketplace. What are those big dynamics? The growth of defined contribution is coming down the tracks. There is a requirement there, not a hope for, a requirement to have daily trading. The situation with open-ended funds is going to have a requirement for daily trading. Even though we can play at the edges, there are fundamental changes going on that we need to address. And in terms of the hunt for yield, and all the property players on this call, and there are other who are non-property, but if you are getting 31 basis points from bonds, and the equity market is reducing in size, real estate really is the option that you should be looking at. So those are fundamental opening comments. The second point is IPSX, what it is and what it isn't. And firstly, although some people say, oh, it's a new stock exchange exchanges have been around for 300 years. They're well known, they're regulated, there's an infrastructure in place. And so the important thing to actually bear in mind, and IPSX has been a long journey. Certainly when I took up my board appointment, I had no idea that it would take the best part of 5 years to secure a recognized investment exchange license, which we did in January 2019. And during 19 and 20, the infrastructure to allow to trade shares were put into place, and we secured a second stock exchange for professional investors. I haven't got the time here to go into that, but it's well documented on the website, and a bit like Stephen, I invite questions to me in terms of any more detail, which we would be more than delighted to give. Now, the listed vehicle that you float on the exchange, which has a single asset or assets which have commonality, think of a business park, think of Brindley Place, is a company which has a regulation through its board. What IPSX isn't, and I've had lots of questions like this, mainly because I come from a brokerage background, is it doesn't pay introductory fees. It doesn't buy buildings and hold it on its account. It doesn't yet run an index, but boy, an index is long overdue with a public market that we should be looking at. Ladies and gentlemen, it's a marketplace where buyers and sellers come together and exchange real estate. It's a piece of capital market infrastructure that Michael Mallinson could only have dreamed of. It is a public market, and it's the real estate stock exchange. I suspect there will be one question which says, but we've got the London Stock Exchange. Why do we need a dedicated real estate exchange? The London Stock Exchange today has 1,100 companies on it. It has a market capitalisation of £3 trillion. And the property element of that is 55 billion. It is a rounding error. We need a dedicated exchange. And the third section I just want to touch on today is public sector funding. Why do I actually want to draw this out? Well, nobody can have missed that from a public sector point of view, that there have been changes in the public sector. We've seen the local authorities buying commercial real estate. We've seen how the public sector or Public Works Loan Board has been constrained in terms of providing grant. And the private sector and patient capital is going to be required to facilitate some of the new developments and schemes that are there. JVs and partnerships between private and public sector have a long history, and dare I mention the dreaded initials PFI. But actually, the previous models have always never been based on an equal sharing of risk. And indeed, today we have annuity funds and others looking for long leases from the public sector. But how sensible are those long leases in respect of the fixed uplifts and RPIs? Are they super senior debt? Yes, you can have the property back, but is that the best thing for the local authorities and the public sector to be doing? It smells a bit like PFI to me. So now imagine a new structure with one class of share, which is onshore and regulated. The participants are entirely aligned because they will have equity shares and the ability to exit, which most of those joint venture agreements that we've all been involved with really is a ball's ache at the end of the day to wonder how the exit provisions work. But if you are on a public regulated market, that gives great ability. Corporate governance, and boy, has this country got corporate governance in terms of its public boards now, is second to none in the world and will pay huge dividends to us. So I've covered three areas there, some fundamentals, a quick introduction to IPSX with an invitation as a public market, a new way to invest, holding shares and selling shares on a daily basis, and the importance of a public exchange for public sector funding. Which only leaves me to introduce Stephen Barter, who I've known for many, many years. He's known in the industry as the father of fractionalization, the senator of securitization, and the master of markets. Stephen, over to you.
Thanks, Rob. What a build-up. I'm tempted to say I should leave now before it can only get worse, but thank you so much. Well, this is a real déjà vu for me. I've been involved in real estate as an investor, developer, and advisor all my career. This idea has been the holy grail for a lot of us for a very long time, and it's brilliant to see it finally happening. Property, as we know, is, I don't need to tell this audience that property is a good investment, but equally that illiquidity, its relative illiquidity, has always been a challenge. And what we're talking about here is a tradable equity share in a single property, providing a direct participation in the property's rental income and capital value as if the property was owned directly, but with the benefit of tax transparency and the potential for leverage, but without the obligation of management. And the opportunity for immediate liquidity through a regulated exchange. Instant liquidity, faster, cheaper, and more certain than undertaking a normal property transaction, and all onshore. So this is in a way the modernization of the property market, allowing smaller investors into a world previously limited to the big boys and girls, but with all the safeguards of a proven REIT concept, professional management, and a regulated market for trading. So I'm going to talk today a little about some of the history that Rob alluded to, something about Mailbox, which will be the first property to be listed in this way, and its potential wider applications. Now, this all started for me in 1985, which feels like a million years ago. And the City of London was about to modernize itself through something called Big Bang in 1986, and the introduction of a new series of financial services acts and regulations. And a group of us got together and said, let's see if we can crack this. This is the kind of environment when, if anyone has a chance to do it, it should be now. And we moved very quickly, and it was quite interesting. There were two other competing groups. It was a bit of a race to see who could come up with it. We weren't trying to create a vaccine, although I think the parallel wasn't lost on me. And in 1986, we managed to persuade the London Stock Exchange to allow single properties to be listed on the main market. This was absolute extraordinary game changer. And we had 3 properties ready to list, and there was a massive industry following. This really was very big news at the time. A lot of people getting very excited, and inevitably with the property market being fleet of foot and creative, a lot of people were thinking of highly imaginative ways of how they could use it to make money and provide opportunity. Unfortunately, there was a big financial crash in 1987, which meant we had to stop. And it also coincided with a change in the regulatory rules for this kind of arrangement, the introduction of so-called collective investment schemes. So to capture the moment, I wrote a book about it, which you can still get on Amazon if you have the time to spare. And I have to say, I reread it recently, and it's all there. It's still the same. And it talks about the changes that were being made at the time to property finance. And I was helped to create what I think was one of the first private equity property funds at the time. Banks were coming back in, leverage started to be talked about. The capital markets were clearly changing very radically. It was an incredible period of change in investment, and real estate got well caught up in all of that. But then 20 years later, we had to wait 20 years for the Real Estate Investment Trust to be introduced into the UK. That took a government decision, which happily was made in 2007. And all the major property companies of the day converted themselves into REITs and still are. So now we have a almost 20-year track record of that market with us. And of course, REITs you will find in the United States, in Japan, in many other countries around the world. And then in 2014, with Rob and others, the idea of a single property REIT being listed on an exchange was revived, but this time the idea was taken to create a new exchange for it, and rapidly accelerated. And a guy called Richard Croft, who runs M7 Real Estate, really turbocharged that, became involved in IPSX as a shareholder, as a board member, and decided to go and buy a property so that that property would be the first property to be listed on this new exchange. And that property is Mailbox. And he very kindly asked me to be chairman of this Mailbox single property REIT. So Some of you will have read about this in the press. I'll talk a bit about the property in a second, but just to bring you right up to date, we had to pause our work on the listing at Christmas because M7 was engaged in a transaction to be acquired by Oxford Properties, which is part of the giant OMERS pension fund of Canada. That deal has now completed. You probably saw the press a few days ago. And so now we can press on. And our plan now is to list Mailbox on IPSX wholesale, which will enable it to be shares to be bought by professional investors, £1,000 minimum investment, but as a single property REIT, it allows a slightly higher leverage than the retail part of IPSX. We'll have 60% leverage here, still paying a quarterly dividend. We'll release into the market just over 25%, about 26.25%. The rest will be retained by M7, now Oxford. And Oxford, of course, now find themselves as a shareholder in IPSX, are very supportive of the whole exercise. So it means it's very helpful, I think, to find one of the biggest institutional pension funds very supportive of this idea. Simpler to list on the wholesale market, although we prepared a prospectus for the retail market. We only need something called a listing agreement for this, but essentially full disclosure of the property and management information that you would find in a normal prospectus anyway, with a board of directors. So I'm joined by Ian Womack, who used to run Aviva's property business, and Michaela Wilson, who has had many roles as a director of property companies and used to run the Guardian Royal Exchange portfolio. So all three of us have been around a while, and M7 will be the discretionary manager of the company, day to day, responsible for its asset management and future growth. The other point technical point I'd flag about the structure is, as Rob alluded to, unlike some of the open-ended property funds, there's no risk of gating here because this is a listed company, like other listed companies on the stock exchange. They're open for trading the whole time. They're subject to takeover and all of those kinds of things, exactly the same environment. And I think given the, the current pattern of behavior, I think that's really very helpful. So all being well, we hope to be able to complete the listing by the end of Q1 this year. And then we're bringing forward the second property, which has been announced. It's an office building in Leeds called Bridgewater Place. It's the tallest building in Yorkshire, I'm told. I don't quite know what that means, but it means it's an office building occupied by largely professional firms, Eversheds and Ernst & Young, among others. And we're trying to bring that on board a bit faster too, so you'll have two properties to look at on this market. So as far as Mailbox is concerned, very quickly, what you see is essentially what you'll get. This is an office-led landmark mixed-use building in the centre of Birmingham, next to the Bull Ring, and about 2 minutes walk from New Street Station, less than 10 minutes walk from the new HS2 station. And central Birmingham, like other cities, is now much more mixed use than it was. It's really a 24-hour place, at least when COVID restrictions aren't applying. The key to its share performance will be active management to provide income and asset value growth. Now, we've completely rethought the asset management strategy, anticipating the impact of COVID to be more relevant to the life-work balance we expect to see emerging from the pandemic lockdowns. COVID impact has already been baked into the pricing, therefore. It's very much a building for our times, which we expect to continue to evolve. There are 46 tenants anchored by the BBC, who pay 23% of the total rent roll. It's where they make the Archers, just to make it interesting, which is celebrating its, I think, 70th anniversary this year. And with the biggest car park in central Birmingham, 687 places, a WALT of 14 years. And the office and car park tenants certainly been paying 100% of their rents in recent times. The overall rent collection has been about 75%. But the dividend yield is well covered by the office and car park rent only, without the retail or hotel income. So there's F&B, retail, hotel, offices, all within the building. About 2,500 people are employed there, so a significant employer in central Birmingham. Very much focused on the creative industries, media and tech, obviously partly triggered by the BBC, but lots of other interesting things happening there. The market value is about 181 million. The rent roll is about 9.3 million. What we are going to do is lever it 60%, 110 million, a NAV of 80 million. We'll be raising 21 million, as I say, just over 25%, to produce for investors an initial dividend yield of 6%, which is paid quarterly. As I say, well covered by the non-retail hotel income, which we expect to rise to 9% per annum over the next 3 years, which is a lot more than you'll get from build to rent. And we're projecting an IRR over 15%, over the first 3 years of 15%. So really a very attractive opportunity. We've also had the income quality assessed for its credit quality at BB+. And if you think that the indicative yield for a UK corporate bond with a BB+ credit is currently about 2.7%, this is 6% and increasing, and that is 2.7% and fixed. FTSE 250 dividend yield at the moment around 3%. So those are the sort of benchmarks that we're looking at. Management costs about 0.375% of the NAV. So if you compare that with the management costs of a leading listed land securities, British Land, this is because it's completely transparent. Nothing is hidden. These costs are only costs for managing this building. So I think all of that tells you, I hope, some of the thumbnails about this building and why it seems a very appropriate property. I would say that, like listing any other company, why do you buy the shares? You buy them because you expect they're going to go up in value. You expect management to do a good job in growing what it's got. And this is the key to this asset. And as I've just explained, I think we thought that through very carefully. Finally, just some of the few wider applications that this new environment will allow. Let your minds wander for a bit, and I think you'll quickly see all sorts of possibilities here. IPSX Wholesale, as Rob has implied, allows joint ventures and partnerships to be listed. And if any of you have been involved in those things, you'll well know that you're stuck. You're a partner in something where you have not much value. You don't know what the value is from day to day, and you can only sell if someone else is prepared to buy you out. And in this case, you can list the whole joint venture or the partnership on IPSX, and you can slice it and dice it as you wish. And there's continuous pricing and therefore a continuous indication of value. And I thought it was very significant when we announced the listing intention of Mailbox. Andy Street, the mayor of Birmingham, mayor of the West Midlands, in fact, posted a tweet where he said, this potentially brings together public and private sector investment and could open up some interesting opportunities for local authorities and other public sector organizations to raise funds in a totally new way, i.e. a new approach to public-private partnership. And I think that's really exciting, particularly when it is very clear, and we may be able to talk about this more in Q&A, because I should stop now, that we can apply this to developments, to the creation of managed funds, and really think through how this can help the issues that the funds, the FCA's current review of open-ended funds are likely to bring. So I should stop there. I hope that's helpful. Look forward to the Q&A. Thanks, John.
Thank you, Stephen. I think, yeah, that was really interesting, and due to hand over to Adrian just in a second, but just as a prompt and a reminder for everybody listening, we've had a couple of questions on the Q&A function, but if you could get your questions in, that will allow us to run a really good Q&A session shortly. But over to you, Adrian. Look forward to hearing from you. Thanks.
Great, thanks very much, John. I think in the interest of time, I'm going to keep it relatively short because I suspect people will be very keen to get into much more of the Q&A session. So if I might just give you a very quick intro in terms of what we do at Fidelity, particularly around real estate solutions. And then also perhaps just remind ourselves about the context, the environment that we find ourselves in today, and quite why the notion about fractionalization and all these other weird and wonderful terms like blockchain and other things are suddenly coming into our parlance. So when I use these words deliberately, when I stumbled into the real estate industry back in the 90s, it was very much, first of all, as a civil engineer, trialing that, but coming out at a time in the UK economy when, quite frankly, there weren't very many jobs, but the handful of jobs that there were available very much in the finance space. And then suddenly I found myself in investment banking in the real estate department, working on joint ventures in the first instance, then suddenly finding myself doing things like taking private real estate companies that had been listed and going into private hands. Then suddenly found myself working on helping the introduction of REIT legislation into the UK. Then promptly found myself then doing take privates of some of those REITs. And so what I've come to realize actually over the last few years is a very simple reality that we all face in real estate is the nature of capital has so very rarely suited holding real estate for the longer term. There is no one magic solution. And so from my perspective, just so there's no ambiguity on this, I think IPSX is a fantastic innovation, but there needs to be other forms of innovation. We need as an industry to give the very different natures of our clients different options to access the underlying asset classes. And to date, we as an industry invariably have actually said, no, we'll give you lots of access to the asset class, but not necessarily the means in which you actually get access to it. And that's really the challenge we have. And I think in the UK, it's even more pressing. So it was interesting that Rob and Stephen have been talking about somebody who, quite frankly, unfortunately, I don't really know much of, but sounds to have been, certainly somebody I should have got to know. Forecasting, the journey to some extent that we've been on over these last few years. But when I look at it, I guess more in, I've got still another 20 odd years to go in this industry. There is huge amounts of opportunity, but also challenges. And I do sincerely believe that we are at one of those potential forks in the road. And the challenge is this: our capital base that used to secure UK real estate is moving away. Defined benefit investors used to be the mainstay of the UK real estate market alongside overseas investors and others. That is now moving away and looking at different types of investments. DC investors, we all hoped would start to pick up the slack, and they're finding it challenging to access asset classes like real estate. It's not unique to real estate, but it's asset classes like it. Coupled with that, we've got huge amounts of disruption. My father would have simply called it change, just very fast change, happening in terms of our occupier base. Those companies that are supporting the lease structures, which are ultimately the primary means by which we deliver our performance to our investors. So the question is actually, what opportunities do we see coming down the line? And things like IPS are very exciting, but there's also other opportunities out there, and those are some of the things that we've been exploring as a company. And so the kind of things which we're talking about are the use of digitalized assets. So the most obvious expression of that is Bitcoin, but that's just one example of it. What we're talking about is actually how we can use digitalized technology to revolutionize how investors get access to non-traded instruments. So if I can put a picture in your mind, for those who can remember PEPs, so the precursor to ISAs, we all had to fill in paper-based forms, post them in, then we'll be told when we were invested, how we're invested, and will be paper-based information around that. And now, fast forward the clock today, we can do that all on our phone. We can execute those trades at a time of our choosing, rather than when somebody decides to open up an envelope and execute a trade on our behalf. That ultimately is where industries like ourselves need to be moving forward into. And now finally, there is the technology to actually power up that opportunity. But what actually is required for us as an industry is really a much better understanding of what truly powers that up. And that is the provision of data. Data underpins the modern economy, whether we like it or not. And yeah, our industry prides itself to some degree on secrecy, not sharing too much in the way of data. So, you know, one of the underpinning things about IPSX, which I know Stephen's touched on, and I'm sure we'll touch on in the Q&A, is the availability of information to support a price for investors to take comfort in. And as a result, that is what is going to underpin this liquidity and consequently the secondary liquidity, etc. And I think very much that is something that we have to embrace, because if we do not, other private asset classes will. Now, I know that's a quite sobering message to take on board, but it's something that I, sitting in Fidelity, have to deal with every day, because real estate is competing against now so many other asset classes to grab that capital, to make it its own, and to, you know, to generate the performance. So if we don't, we'll be left on the sidelines. We will be left as an industry to shrink rather than to grow. Now, I personally see that there's huge opportunity, and this is where, you know, I do want to end on a high note. We've been through two monumental social experiments in the last 10, 15 years now. The first one obviously started in 2008, when it was decided that to get ourselves out of a financial crisis, we're going to have the biggest financial stimulus package that the world had ever seen up until that point in time. That continued and was continuing, and now is just being restarted in the last 12 months. Somebody has to pay for that. Banks, central banks, governments can no longer afford to do so. And so the challenge that a number of central banks and a number of different finance ministries across the globe are wrestling with this simple, single question. How do they get private wealth to invest in our economies? And that's where I see innovation like IPSX and other things like digital assets, like tokenization, as being the means by which this might happen. So if I can leave you what the art of the possible might look like. So we've had Andy Street as somebody referring to, so I may as well stick with the West Midlands theme here. We're increasingly thinking about things on a localized basis. And yet on real estate, we do, but we don't deliver it in that way. Can one imagine then, if we need to fund things like local schools infrastructure, or we want to fund a local regeneration program, let's say in a specific suburb in Birmingham, is that possible? Do the structures that we have make that possible? No, they do not. But certainly the technology is now and being delivered to be able to make that possible. In effect, crowdfunding for your local school, with all the governance and all of the things that one would expect from an investment proposition. And that to me is actually very much the art of the possible. We often underestimate how long some of these things might take in the short term, but certainly even bigger underestimation as to what the true transformational potential might be over the medium to the longer term. Now, quite often those people who reference that talk about it in, very much in the last 4 or 5 decades. I think we need to recognize, though, we're in a digital age where things are accelerating far quicker. And I think, yes, there are challenges that we have to overcome over the next few years to meet some of these things. But I do think within the next 5 to 10 years, if we were to have this, revisit what's been said in this call, we may well have actually not been optimistic enough, or even, what's what I'm looking for, ambitious enough as to just quite how much change has actually had to have happen. And as I said today, it's very much a function of the situation we find ourselves in. It's less of an option, but almost an urgent necessity to bring about this change. So on that note, John, I will end.
That's great. Thank you very much, Adrian, and thank you to Rob and Stephen as well. I certainly found it very, very interesting listening to the three of you speaking. So thank you for that. And thank you to those who have submitted questions. Just as a reminder again, we've got some good questions to start, but if you would like to post a question, please do use the Q&A chat box as part of the software, and we will do our best to answer as many of those questions as we can. The first one actually just picks up on something Adrian's just talked about, and Stephen as well, and it's to do with the transparency of information. Clearly, in a real estate world, we often trade on kind of, I suppose, imperfect information, and hence the requirement for environmental building surveys at acquisition, and then seemingly endless measured surveys where surveyors have different methods of measuring things. How are we going to get around that as part of this sort of brave new future? And I suppose it's a question to be answered by all three of our panelists. I mean, Adrian, do you want to kick us off with your thoughts, given your views, please?
Sure. So let's tackle it where it is. We've built a business on the notion, well, not just a business, but an industry on the back of the notion of an independent valuation. That's no longer fit for purpose for everything that we use it for. It's absolutely fit for purpose for certain aspects, but not for setting the price for an instrument that actually clients are looking for to be able to trade on a more regular basis. So what other data points do we need to be able to provide in order for clients and investors to enable price discovery, not on a monthly basis, but on intraday basis? So if we look at what's going on in the equities and fixed income world, they've perfected it. There are models out there already, and just think about the avalanche of data and metrics available to them. So bring this to life a little bit more. Google Maps and the Google data, we all saw what Google is able to assemble in terms of data in the early COVID. I don't know if you all saw the charts about footfall and how those are changing between supermarkets and different forms of retail stores. The data is already out there. It's just simply something that we either don't have access to or are not utilizing. And these are the other forms of data that I think we as an industry need to get wise to and be embracing and using as ways in which we can better price and forecast what it is that we're holding on behalf of our clients.
Okay.
So quick question, to the answer to that question from a data point of view, all around us, and it's been accelerated over COVID, have data sources. A separate topic, John, but clearly Dan Hughes has been doing a lot of work on the Real Estate Data Foundation on standards of that data. So there is a big issue about consistency about standards. But the fact of the matter is, the last 10 years, we've been living through a digital world giving us more data, whether it be CoStar, whether it be the land registry, where you can find data now on most things. And the idea of, and I think, you know, PropX is dying a death, I'm afraid to say. I'm sure somebody from CoStar will ring me up afterwards. But the reality is, you know, the idea is we're going to get it in first in terms of a data piece. Is starting to evolve, and it's moving very, very quickly.
Great, thank you. I mean,
can I just add,
yeah,
John, that on Mailbox, for example, the information that will be available will be pretty much everything you normally expect if you were going to buy the property. So title, lease details, financial information, financial history, building condition, all those kinds of things are there available and will be regularly updated. In addition, there will be twice yearly independent valuations with directors' valuations in the intervening quarters. So, and every incentive to report the news, good news and bad news in terms of lettings and rent collections and things like that, because that is all the key to continuous pricing and transparency, which this market depends on. So all of that absolutely taken on board.
Okay, great, thank you. An aligned question regarding information and I suppose disclosure. Is IPSX planning to require ESG disclosure for all of its listing? And the question goes further, if not, why not? Rob, Stephen?
A quick answer to that, yes, we are. And indeed, in terms of the whole public sector environment, I don't think there's a seminar you can go to without actually having ESG on the agenda. The E part is getting clearer in terms of environmental, use of energy, use of power, etc. The G part is well advanced in terms of governance. The big question mark and a plug for Land Aid here, sleep out, is the S part. It is very, very hard to measure social impact in terms of the SG because there isn't a defined set basis for that. And certainly as the property industry charity, it's high on the board agenda there to see if we can't help the industry.
Great, thank you. Changing tack slightly, there's kind of three questions which are, I think, linked. The first one is around the listing. Does it have to be a single property? And if so, how is a single property defined on the index? And then linked to that, I suppose, how does the fractional ownership impact upon liquidity of that asset, of that single asset? What would be your take on that, Stephen?
Okay, well, we follow the REIT rules, which are very clear on what is listable and what isn't. And indeed what a single property is. I think, to paraphrase it, it allows not just a single building, but a cluster which is managed together as a cluster. And so you can imagine what that might potentially mean, both in terms of town centres and potentially business parks. There are initially it has to be at least three entities, 3 leases. And there are problems with, for example, managed hotels. The hotel in Mailbox is leased, so that's fine. But the criteria have evolved over time, and I'm sure will continue to evolve. Mailbox, I think, is a great initial example because with 46 tenants, mixed use, it's pressing a lot of buttons. It can be managed in a very dynamic way, and we certainly intend it to be managed in a dynamic way. But Rob may want to add in terms of IPSX's ambitions for the kind of properties. But as I mentioned earlier on regeneration, I think there where the cluster opportunity I think could be really interesting to some of our town centres that are managed as a cluster of high street or edge of high street locations. And that's maybe something for another discussion. But Rob, you might want to add.
Yeah, I mean, just a quick point on the exchange values. Clearly, there is the ability in the REIT rules to list a company of £700,000. My strong commentary to this audience and to a wider audience is that IPSX Prime is looking at £50 million plus, and IPSX Wholesale 100 million plus. The reason for that size is because of the nature of property and because of the cost of running those companies. In terms of diversification and the other REITs on the marketplace, which I think was part of the question, we have a pipeline which is just over 11 billion in total, where we're talking to prospective issuers. Clearly, the one thing that we're not encouraging at the moment is single assets of retail shopping centres, for example, because the market is still finding its level there. But we see a chart, you know, the ability to actually bring something that you can't invest in terms of a alternative invest. I just want to pick up the diversification point because Adrian posed a question, not Adrian speaker, but on the panel of questions, and that is from a diversification point. I've heard this before, and you know there is a required number. All the research that has been done, you need so many properties to actually get diversification. Surely by splitting into pound shares, you can create your own diversified portfolio, which you can then trade, as opposed to being locked in. So although much is made of diversification, I think you can achieve that by the weighting of your holding in a series of shareholdings, rather than looking at a property portfolio. But again, a much deeper topic to be discussed there.
And I think, John, if I can add, I think to echo that, exactly, that always was the objective of this, to allow investors to create their own portfolios rather than have to buy into something created by somebody else over which they have no control of what's in it. And I think that is from a fund management opportunity potentially quite interesting. Somebody's also asked about the costs of listing. Certainly on Mailbox, and this will be a disclosed number, we're looking at just under 1% of the property's capital value as the costs of listing, just under 1%. And the management costs, I think I've already said, 0.375% of the NAV. So I think by any stretch, that's pretty competitive.
Great, thank you. I'm just conscious for time, so I think there are some further questions which the panel will try and answer as we go. But I'll just do one further question, which was almost a question in two parts. The first one comes from Andrew Brazier, which is just talking about the potential for demand and where that comes from, and if there is a lack of demand. Clearly you're hoping there isn't, but if there is a lack of demand, how will that impact upon establishing market value? And then a linked question to that is from an anonymous attendee, which is probably interesting. Will Fidelity be an investor in the Mailbox listing? Which is probably Adrian giving the game away as to whether that will be included in your strategy or not. But perhaps Robin and Stephen could answer that first point around demand, and then over to Adrian as to potential strategies from a Fidelity point of view, please.
So to Andrew, and hello Andrew, it's great you're still fighting the good fight with the West Midlands branch of the IPF, so that's fantastic. Quick answer, I remember London Fox as well. You'll remember the days were very different then. I think your probably average return was 6 to 7%. There were lots of alternative asset classes. Just one quick stat before Stephen comments. There are 25 million investors in national savings and investors. As at the end of their fixed term bonds, in terms of return, it's gone from 1.9% to 1 basis point. 1 basis point. There is a huge demand for yield out there, provided it is regulated and properly nurtured through. Yeah,
I think demand's the $1 million question, of course. all I can say is the feedback we're getting is there is terrific excitement about doing this now. We've spoken to a number of industry leaders, and you'll be seeing something in the next couple of weeks which reflects widespread support from property industry leaders to IPSX. And so many people have said to me, this is just so right. It's really about time we did this. Let's not mess about anymore. So I'm very encouraged by that, very encouraged.
Right. Adrian, what about Fidelity's strategy or otherwise? Can you give us a hint?
Yeah, sure. So I can't speak on specific mailbox or non-mailbox. So if I can just reiterate, all of my comments were very much addressed at IPSX as an exchange as opposed to as a specific listing that they're working on. And it's that which very much I would be in support of. Addressing what we're specifically doing at Fidelity, for us, it's actually exploring about where in the digital asset space, one can take the same approach that IPSX is making, which is very much in the listed form, and actually applying that in the digital space. And whether that might be a digital assets exchange, where you're promoting either real estate funds, or it could well be infrastructure funds and the like instead. And the reason why we're exploring it in that way is we're trying to find a solution that doesn't just simply work for, say, UK-based solutions, that's actually global investment solutions, but then as well, the nature of investors. We're cognizant of the fact that accessing private markets in its widest sense is going to accelerate exponentially over the next 5 to 10 years. So if we look at, for example, Nordic investors, institutional investors, historically they used to hold less than 5, maybe 10% in non-liquid instruments. Today that's closer to 25 to 30%. And the reason why I state that as a group, they tend to be the bellwether as where the rest of the industry is heading toward. They tend to be about 10 to 15 years ahead of others in that, on that journey. And that's certainly something that we're already seeing. Like I said, for us, it's very much about looking and saying, can we do this in the digital space? Because I think investors' needs and demands are changing. COVID highlighted that, it really pushed our business models to the absolute breaking point. And now I think senior management teams across the industry, not just in real estate, but across the finance industry, are realizing actually relying on old technology in a modern era has its limitations. We know where those are. Can we actually do that in the digital space? So whether that's digitized tokens, whether that's Bitcoin, whether that's other things, remains to be seen. But certainly that's a direction of travel that we're pursuing.
Great, excellent. Okay, well, I'm conscious for time, so we will look to wrap up here. But I know certainly Rob and Stephen have very kindly offered to answer any further questions, particularly around IPSX, clearly further, and we will work out getting email addresses for further Q&A sessions if that's required. Just to close out this afternoon's session, a couple of dates for your diary and further events which are being run by the IPF. The first one being on the 2nd of February, next Tuesday. There's a webinar entitled A Tale of Two Crises, looking at the responses to both the GFC and hopefully the aftermath of COVID-19, and to look at some lessons learned and how we can do things better, exploring some trends, some further trends for 2021 and beyond. The second one is a briefing exploring the developing resilience to climate change and actually how we can do that from a pragmatic approach, clearly picking up on some of the ESG themes that we've talked about in our session earlier. And then lastly, just to also flag the research piece which has been done on operational real estate and how that's going to impact upon our market going forwards. There is a further webinar for that on Thursday next week as well. So I'll leave you just to say thank you very much to each of our three panelists, to Rob, to Adrian and to Stephen. I'm sure, like me, you found that really, really interesting and invaluable. And thank you for your time, and best wishes for 2021. Thanks very much.
Indeed.
Thank you.
Thanks for hosting.
Cheerio.
Cheers, John.